Welcome to Lifetime Cash Flow Through Real Estate Investing. I'm Rod Khleif, and I am absolutely thrilled that you're here. And we have a very unique interview today, a topic I've never really brought on the show before. A really nice guy flew down here from Toronto for this interview, and his name's Andrew Kim, and he's the CEO and co-founder of a company called Share. And I'm not going to give you much more of a bio than that because I think he'll do a much better job of explaining who he is, but excited to dig into this with him. Welcome to the show, brother.
Thank you. Thanks for having me.
Yeah, absolutely. So, Share, you're from Canada. I know you told me it's an American company, but it's a tech company. Tell us what you do, man.
Yeah, so Share, we're a real estate investing platform. We work with everyday mom and pop investors looking to get into single family rental homes in a low risk, low effort way. So we work with you, understand your sort of 5-10 year outlook, and help you enter the market by sourcing deals that match your buy box and criteria, getting it rent ready and stabilizing that for portfolio growth. And what we want to do is put your portfolio growth on autopilot after that.
Okay. That was a lot that you just said. So you'll talk to somebody that has maybe has their own home, maybe doesn't, wants to get into an investment property, maybe has a couple of bucks, has never done it before. And so talk about the process. You said you help them with their buy box. What if they haven't got a clue what their buy box is? So speak to that a little bit.
Yeah, so our onboarding will kind of go through some questionnaires and get a sense of what they understand, what they don't understand. Are they new or are they experienced? And then based on that, we'll push to a call if they don't have those types of answers.
I see. So it starts online. They fill out some answers. They fill out a fairly exhaustive questionnaire, I would guess, or informative. Maybe that's the wrong word.
KYC light, let's call it, know your customer light.
Okay. All right.
And then if they're interested to pull the trigger at that moment, then they'll push for a phone call. Okay. And then one of us will get on a call with them, understand what their sort of investment horizon, timeline, risk appetite is, and then help them find a home that meets their sort of investment criteria.
And so your platform sources on-market and off-market deals around the country?
Correct.
Okay. And then what happens then? Let's say you identify a house that would be good for them in the market that they'd be interested in. Do they play a role in the market selection?
So we will boil that down to basically what their criteria is.
Gotcha.
Trying to shift them towards, A and B class homes.
Mm-hmm.
Obviously trying to ones that we can elevate in terms of equity wise. And then if we're aligned on that sort of deal, there's that cash to close line that's on our pro formas, then we ask for proof of funds, then we turn on our search.
Okay.
Behind the scenes, we're sifting through deals automated. Then that goes to a short list to our head of investments. We QC it, send it to our local PMs and agents. They make sure. He
means property managers.
Yes.
When he says
sorry.
PMs.
Yes.
Mm-hmm.
Local property managers and brokers make sure we're not out to lunch. If it looks good, then we will put in a conditional offer. And then if they accept, then we present it to the client.
Gotcha.
If the client likes what they see, then we'll sign an assignment agreement. We'll send our scope team out, tighten our CapEx assumptions and our 10-year R&M assumptions. And then
repair maintenance assumptions,
yes,
right?
Repair maintenance, yes. All the sort of bottom line items. And then if they like it, then we go ahead and close. If not, we terminate and keep the search going.
Gotcha. Interesting. Okay. Do you charge an assignment fee?
That's a 3% upon
That's the
closing.
acquisition fee you talked about before we started recording. Okay. Yes. Yeah, very reasonable, by the way. 3% is very reasonable. Okay, so you charge the 3% acquisition fee, and then I know you're involved in the asset management after the fact, correct?
Correct.
Speak to that a little bit.
Yeah, so we plug into we work with third-party property management company.
Right.
Typically only works with institutions, and
so let me stop you there. So you work with large property management companies, institutional grade property management companies. Okay. And I'll tell you, and let me elaborate on one of the concerns I had until you told me that, because there are a lot of fly-by-night property management companies out there, especially in the single family space. In my world with 100 plus apartment units, there are very sophisticated management companies, third-party property management companies. But in the single family space, there are a lot of brokers that do it on the side, and I can't tell you how many problems I've seen, myself included, when I had assets in Memphis and so on, and just crappy managers. So the fact that you're dealing with institutional grade is a big deal, huge deal.
Yeah. The smallest one we have is like 800 doors in a specific region.
That's really good.
Yeah,
that's really good. Okay, so you source the deal for them. You put it under contract and you assign it to them for the 3%. Like I said, that's a really good deal. And then what happens then? Do you help them with the financing?
So prior to kind of searching,
Okay.
We'll work through the financing strategy,
Okay.
make sure the numbers work. We run the performas against those sort of sensitivity tests.
Mm-hmm.
And then we send out a preliminary sort of request to like thousands of lenders to see who kind of matches and make sure we're close. And then if they need financing, that will also be sort of our conditional offer. And then once they sort of our offers accepted, we'll go and push out for a hard request for that financing.
How's the interest rate environment affected what you're doing?
It's really high.
Yeah.
Yeah, in the 8s.
Yeah. I mean, how's that affected your? Have you seen pricing come down to start to justify this interest rate yet, or is it still sellers still holding on a little bit?
Yes and no.
Okay.
In the regions we're going after, we haven't seen that much of a price adjustment yet, hopefully we won't. It just means typically a larger down payment to make things cash flow positive.
I see. Well, actually, I disagree with you. I think hopefully we will see price adjustments, and if you can buy these things at a lower price, then when the rates come down, you refinance, no big deal.
Yeah.
So I asked you before we started recording if you're using Fannie Mae. I know Fannie Mae just dropped their down payment requirements, which was a huge deal. Do you know what? I forgot what it was to. Like from what to what? I think it was like 10% or 15%.
Oh, was it?
Now it's 5%.
Okay.
I think it's 5%.
Oh, really?
Yeah. It's 5%. Yeah. So it's 5%. They've dropped their down payment to 5%, which is huge. Now, you said you do more DSCR loans. DSCR, guys, means debt service coverage ratio, because you're looking at a property's ability to service the debt. And I wasn't very familiar with those loans, but I know they've become more mainstream. So you're seeing more 8% right now in that debt? Okay. Now, guys, just so you know, I mean, 8% sounds freaking staggering. But when I started in the business, the interest rate was 18%, okay? And I remembered freaking out when it hit 7%. I'm like, holy shit, it's only 7%. So just to give you some context. All right, so you source the deal, you finance it, they buy it basically. And I told you I was very against turnkey, okay? And I get into it with some of my confederates that are good friends that do turnkey, because for a couple of reasons. One is the profit's already gone. Obviously, the person selling you a turnkey property is going to sell it for market value and make some money on it. So they're like a flipper, just a fancy flipper. So what you do is different, because they're buying the house basically whatever price you can negotiate at a deal, and so that's different. And then I did express another concern, and I would like to discuss it. When you're a one-off home with a management company, you don't have much leverage. I mean, like when I've got a 100-unit apartment complex, I've got some leverage, because if they lose my account, that's a big deal. But, I suppose the caveat there is you're dealing with sophisticated operators. So it's not like a mom and pop, but that is a concern. I've heard complaints about that from people that have bought turnkeys and they have no leverage. They get screwed on the maintenance and things like that. You want to speak to that a little bit?
Yeah, we mulled over that for quite a bit of time.
Yeah.
And then my co-founder, who comes from a large private equity shop, was like, we should be using institutional.
Right.
We can go in there. That way we got economies of scale, and we threaten the whole portfolio if they screw up.
Oh, good.
Yeah.
Okay. So because you're asset managing it.
Yes.
Okay, that's the piece we didn't get into yet.
Yeah.
So guys, what he does is how we've got asset management, property management. He's asset managing the management companies.
Yes.
So you do have leverage then.
Yes.
That's a big deal.
None of our contracts are sticky. 30 to 60 day termination notice.
Okay.
And we have redundancy of at least 2 or 3 other like kind PMs, property managers in that area.
Okay. Well, that's really good. So you handle the asset management, and you charge like a quarter
percent to 1%, depends on that portfolio value.
Okay. So 0.25% to 1% of the rents.
Purchase price.
Oh, purchase price.
Yes.
Oh, interesting. Okay. Interesting. Oh, that's interesting. Okay. I don't know how to do the math on that in my head. In asset management, in what we do in property, in multifamily, like we're at 2% of the gross collected rents.
Right.
So that's how we do the asset management fee, based on the rents collected. I can, obviously this is more when you're doing it on the value of the property, but so what determines that?
It's the total portfolio value with us.
Oh, I see.
As it goes up, it'll go down to the quarter point.
Oh, I got you. I got you. So if they buy more than one house through you, then it goes down.
Yes. It's like 250, 500,000.
Okay.
North of 3.
Oh, this is the value of the home.
Yes.
Gotcha. Okay. No, that makes sense. And talk about, a big thing for me is control. I'm a control freak, and that's why it was really hard for me to start buying out of state. But a big piece of that is dealing with renovations. And you're buying assets that need renovation, correct?
Yeah, it's the buyer's choice if they want something with just punch list items, just a few like touch-up cosmetic, or like a
big lift.
Yeah.
Okay.
Right now we're saying, if you're going to do a deep lift, you should probably self-finance this because the bridge interest rate, when you add that in there, they don't pencil the deals.
Oh, interesting. Okay. So basically pay cash and then refinance when it's done is what you're saying. Gotcha. Okay. When you say, I'm assuming that's what you mean. You say self-finance or hard money or something.
Yes.
I don't know. Okay.
Non-interest bearing.
Non-interest bearing. Okay. Got it. Now you say you push people to A and B properties. Why is that?
Just for safety and security reasons. Let's say if you're a novice, you should probably get into a B or like a B neighborhood where you can actually uplift. Yeah. Or,
I know why. I just wanted to hear you say it.
Okay.
I am absolutely avoiding C assets right now, and for a lot of reasons, but especially for somebody brand new. But here's the thing. Inflation is killing people right now. I mean, I go to the grocery store, I'm like, holy shit, that was $100 for that little bag of stuff. And gas is insane. And what demographics getting killed? The ones that are in those C assets. Mm-hmm. And so, I absolutely am avoiding anything below a B right now because, it's like a flight to quality, really. So I'm really glad to hear that. And especially for a novice. Although from what I hear, it doesn't really matter if they're new because you're pretty much handling everything.
Yeah, we try to mitigate the risk as much as possible. Our underwriting is pretty scrutinous.
Okay.
Like when we work with some of our wholesalers, they'll be like, here's a 9 cap. And we're like, this is a 6.
Right.
There's all these lines in the zip code that
so you're actually using cap rate on single family homes.
Yes.
Interesting. Well, tell me a little bit more about your underwriting. To take a look, what do you take a look at when you underwrite?
Yeah. So my co-founder, he does this. That's his sort of realm. So I might butcher it. But he looks at everything from surrounding economics, from job growth, population growth, household income. Then he goes down to all the R&M vacancy, and he doesn't kid himself about it. And he comes from actually the multi-world. Okay. So he takes that institutional knowledge, understands the vintages, areas, and really makes sure that we kind of over allocate on some of these R&M and vacancy assumptions.
Repair, maintenance, and vacancy assumptions. Mm-hmm.
Yeah, and then carrying costs, because oftentimes that's
that's relevant. I mean, you're going to have some carrying costs. You're going to have debt, and it's going to take you a while to fix it up and rent it. And people forget that.
And taxes, like we see like almost a full percentage points in some of our competitors that like they just loosely assume that it's just an incremental change year over year. Whereas like, well, is it non-disclosed state or is it disclosed state? Go look at that number. When do you think they'll assess? Maybe it's in 2 years. And so forth and so on.
Yeah, you've got to know every geographic area is different.
Yes.
Some don't reassess for 5 years. Some do it the minute there's a sale.
Yeah.
And they have ways of figuring out if there was a sale. So you said competitors. You have some competitors doing this?
Yes, like marketplace perspective, and then the traditional local brokerages that do that themselves and they will be the ones managing.
Gotcha. Well, that's dangerous. Okay, that reminds me of a turnkey with a local brokerage doing it. So I really like your model in that regard. Much better. Now, I know you're fairly new. You said you've 40 of these done already. What markets are you in right now?
Primarily Texas and Georgia.
Oh, good.
Yeah, primarily Texas and Georgia, and then we've done some. We're now kind of Midwest. Like we like Kansas, pockets of Ohio. Yeah.
Okay, those are great markets. I've got assets in every state you just mentioned. Yeah. So that's great. Okay. And major metro primarily in suburbs, correct?
Yeah, like the outskirts.
Yeah, because like I was telling Andrew before we started recording, you wouldn't get a national institutional grade property management company in a secondary or tertiary market. Yep. So you got to be in the major metros, which is better anyway because there's a lot more. You don't have to worry about employer diversity, and people can find work in major metros. So. What's been the biggest hurdle for you getting this thing going? Because I before you answer, I mean, I was sitting here thinking about your business model, and I've started 27 businesses, and I'm like, holy crap, that's a lot of work you're doing for not a lot of money. So speak to that if you would.
Yeah, like shockingly behind like operationally and from a tech, it's kind of clear to me what has to be in place. I would say it's the high interest rate environment and not being able to make deals pencil.
Yeah. I do think, I just did a green screen thing on my Instagram today about small businesses, how 30% of the small businesses right now are using credit cards to finance their businesses. What's wrong with that picture, right? And so, I'm pretty bearish on this economy. I think the shit's going to hit the fan here, and I'm telling people, for God's sakes, if you're going to figure something out to take advantage of it, you better learn it fast, because if you're in the thick of it, it's going to be too late. I think there's going to be opportunities to buy businesses, certainly buy every asset class of real estate. I would stay the hell away from office, but I think everything else, I've actually heard strip centers are doing quite well now, which is kind of interesting. But, obviously multifamily is my gig, which I love. But now this is a very interesting business model. So DSCR, how did talk about what sort of financing people are able to get with DSCR loans, because I haven't got a clue what those are about.
Yeah, so they're typically 30-year fixed,
okay,
non-recourse.
30-year fixed.
Yeah, so that's why we're like, okay, if a deal can pencil with a DSCR,
right,
lock it, and then we'll find one with minimal to no prepayment penalties and go out and refi in 3 years.
No kidding.
So we model that in part of our pro formas.
Are there big institutions doing these loans?
They're all I wouldn't say they're large. They're sizable players.
Okay.
There's ones that actually
can you
there's 10,000s of them.
Can name a big one?
Well, we would use like a technology platform that actually pushes that out to like thousands of players. So like this ecosystem has really evolved, and there's so many tools that make it a little easier to shop.
For you?
Yes.
For you. Gotcha. Okay. So you've automated as much as you possibly can.
And we'll continue to do so as we learn.
Are you using AI at all?
Yes, we started playing with some AI models.
For what piece?
The upfront automated valuation models.
Oh, interesting.
As the short, because there's so many houses on the market and off market, so we got to shortlist that.
Sure.
So it's shortlisted, so it's still preliminary. And then on the asset management side, now because we plug into the property management company's software system, like the Buildium or Appfolio, we're gonna need a way to highlight anomalies in that monthly statement. Mm-hmm. Like what makes sense here? Why is that one house here down? Call that out and go ask the question. Yeah, we one of the attorneys I work with has this KPI software for multifamily, which is just kick ass. And I'm presenting it he's presenting it to my warriors. I've got, my students are called warriors, and something I'm real proud of. They own, I think, upwards of 180,000 units now. Since I've only been teaching 5 years, I'm really proud of that. But we're having a warrior only event. Should be 300 or 400 warriors in Phoenix this coming weekend, and but he's got this KPI platform that he created that ties right into all the different softwares, and it gives you just a snapshot and shows you the anomalies. So you're going to want to create something like that for what you're doing. But it's really impressive. So you like Texas, you like Georgia, you like Ohio, Kansas.
And Kansas. Interesting. Kansas.
Carolinas we like too.
Oh yeah, Carolinas are awesome. Yep. Yeah, I've got assets in both of those too. Okay. And DSCR loans, I mean, Fannie Mae is 30-year fixed too, isn't it?
Yeah, they're all pretty much 30-year fixed.
Yeah. So those are great loans. So who's your avatar? Who is your client that you're targeting for this opportunity?
Yeah, so I guess there's two. There's one, majority of ours come from like major, very expensive real estate metros, New York, LA, San Francisco, Seattle. Right. Where local deals don't make sense anymore. Blue.
Sorry, we won't go political, but I couldn't resist. Okay.
Just like, yeah, look, it is what it is, and there's a reason why we look in the red states.
Right, thank you. Okay.
Like if you want to scale your portfolio, you can't do it there.
Right.
Like both from a legislation and from a returns perspective, right?
Can't make it work.
You can't make it work.
Right. So these are people that live there, and they're like, holy crap, how am I ever going to get into real estate?
Or they've done it and they're just like, lying to themselves. They continue to be a W-2 to pay the delta of their mortgage. Right. It's like, why?
They're feeding a property that should be cash flowing.
It's like now you're just in W-2 world for the rest of your life.
Right.
So those individuals that tried local, try to self-manage, now they try to use a small boutique PM property management company, and just nothing's working. Right. We managed to get them over the hump of out of state, and now they're just like, pockets are like, well, let's go for another one. Let's do another one.
Nice. So more high net worth people, or
I would say middle management, like upper middle class. But like we are starting to get some younger kids that are just like, I can't afford where I live.
Right.
Maybe I continue to rent and invest out of state.
Interesting. Interesting. How do you see this evolving? Do you see your business model evolving at all? I'd made a suggestion. You don't have to repeat it, but do you see any other avenues for your clients that you might utilize to increase revenue or decrease expenses, whatever?
100%. Yeah. So the way we look at it, because we are touching every sort of step of the value chain of investing, from search, financing.
Right. That's why I said I don't know how you can afford to do all that, because that's a lot.
Like, well, not much of that is in house. It's all sort of plugging and playing to large providers or networks of providers. But but the way we look at it is like Zillow try to launch mortgages, and they've got a very low attach rate of how many people they refer in mortgages. They look at their mortgage attach rate, it's mid to low single digits, I believe. I think they might have quoted 7%, but when you look at it from an investor perspective, that attach rate's like 100%, because they're always attaching a mortgage to an investment or some sort of loan. So we look at that, and landlord insurance, all these secondary offerings or service offerings that once we have scale, we can just pretty much either bring in a big player to get a piece of that, or we introduce that as part of our own.
Oh, that's a good idea. That's a really good idea. Okay. Now there are some. I was just thinking about something. There are some companies that have large companies that have tried to do versions of this, aren't there? I'm trying to think of one. It's not
Open Door.
Open Door. Yes. Yeah. Okay.
Yeah. So they were their focus is owner-occupant homes, and they were trying to buy using technology. So it would go there, you put your house details, you'd answer a long questionnaire, and they'd give you a cash offer. Then the market crashed, and they were stuck with so many houses on their balance sheet. But that's owner-occupant price points that I feel are, they've managed to screw themselves over on hyperscaling that. Whereas, we are actually on a cap rate sort of
investor-based.
Yes. Yeah. So we police ourselves, right?
Got it.
So if the cap rate, the price goes down after you've acquired it or before you acquire it, then it is what it is. But at least we have a liquidity option of selling it to another investor at that cap rate.
Oh, interesting. I was just going to ask you the relevance of the cap rate with a single family house, but I see you're thinking internally to sell it to another investor. You wouldn't go out on the market and say, hey, this is an 8 cap.
Unless it was going up, like I know an owner occupant wanted to come in, then we'd say, let's put in 10K, do a renovation, sell it for 30
Right.
plus.
Okay.
But with the large REITs coming in the SFR space, there's also now that liquidity option of institution or private investor.
What's your domain, your website?
Share SFR as in singlefamilyrental.com.
Got it. Okay. Share SFR. Got it. So who's in this with you?
Yeah, so I've got 3 other business partners, co-founders.
Okay.
One obviously in the technology space, and then Carmen, who is my co-founder, who lives really close to here.
Oh, she does.
She's in Sarasota, but
perfect.
Shockingly, like we were both at the opposite places for this event. So I came in, she would have come in, or my other business partner, Dimitri, who is my head of investments. He used to be the executive director at Starlight, which is one of Canada's largest private equity shops. They have about $25 billion in multi. And about $7 billion in the U.S. And he used to head up the U.S. arm.
Wow.
So he's the one doing all of our underwriting. He's definitely a fan of yours.
Oh, no kidding.
Yeah.
Oh.
So he's in the.
What's his name again?
Dimitri Burstein.
Oh, nice. Okay. Well, please give him my regards.
Yes, I will. So he would have been the ultimate candidate, because then you guys could chop it up really.
Okay.
But he's done over 7 billion transactions, scaled that fund from 200 doors to over 20,000.
Wow.
So he's done quite a bit. He's young,
and he's
hungry.
the underwriter.
Yes. So he's ahead of our investment.
You lock him in a room with a spreadsheet and throw raw meat in once in a while. And he's thrilled, right? Okay.
Yeah. So he's the one that is always telling me that the deals don't pencil. But you gotta respect that.
My Dimitri's name's Craig.
Okay.
Same thing. And I wanna smack him from time to time because we can't find deals, but we actually think we may have got one today. Pretty excited.
Oh, that's
Hope
exciting.
We get it. Jeez.
So
but we don't want to overpay. Like you don't want to overpay for your clients.
Yeah.
Right.
So he's the one going in there, and we're gonna try to extract his brain and apply his sort of logic to a lot of our filtering.
The more you can checklist and automate and streamline that, boy, the faster you're going to be able to roll through deals. And that's what Craig's been really good at. And I got to give him credit. He's been killing. He created our underwriting software for my students and everything else. So
yeah.
So anyway, so he's doing that. Is that everybody?
Yeah. So it's Carmen as well. So Carmen, she's a veteran. She's actually from the tax and estate planning world.
A veteran militarily as well.
Oh no, sorry.
Okay.
Sort of real estate and tax veteran.
Gotcha.
So I actually pulled her out of retirement to start this business. She built like a $500 million insurance as a service sort of platform.
Wow.
Sold that and got into multi and single like several years ago, and has amassed quite a bit of a portfolio. And
personally,
yes. And then I was introduced to her by a mutual friend when I was my past business, which I was situated in the US. She's the one that introduced me to the asset class. She handles my personal finances, my taxes, my accounting. And because of that, she became the right fit for this. So we can kind of give you some tax and estate planning guidance as well.
Oh, nice.
Yeah. So we will help you with the entity formation and kind of make sure that we're doing everything.
Oh, that's fantastic.
Yeah.
So is she designated in anything? Or
she's a CPA.
She's a CPA.
Yeah.
Okay. So definitely help with the tax planning, and so you can give some direction as to setting up the LLCs and whatnot in the different jurisdictions, or however you set that up. Oh, that's very helpful as well. Man, you guys are doing a lot.
Yeah, the entity formation is pretty straightforward.
Well,
we
you can
plug
go
and play.
online and do that.
We plug and play that. Yeah.
Okay, but you'll have stock operating agreements you can share with them or something. Yeah. LLCs are the way to go, guys. I mean, I teach this stuff, but it used to be corporations, and then it was general partnerships when I got into the business, and then LLCs, something I saw come in the picture, and of course now they're what everybody uses. So you described your partners and their background. Where'd you come from?
Yeah, so I actually grew up low income housing.
Wow. Where? In Canada, Toronto.
Yeah, there's areas of Toronto. There's a place called Rexdale, which is
the hood.
Yeah. I guess you could say that.
Yeah.
They were stuffing like all the immigrants there, and so came from low income houses. My parents sought bankruptcy when we were young.
Oh, wow.
And I think it was my dad who like ingrained real estate.
Is your dad an immigrant?
Yes. Yeah, my parents were they moved from Korea to Canada in the mid 70s.
Okay. Gotcha.
And they were entrepreneurs or attempted entrepreneurs,
Mm-hmm.
and my dad invested money in land, real estate, and he just told me how he got screwed out by a couple partners, and I'm like, okay. And I was driven by food.
Nice.
So I was like, we can never go out and eat. I want to go out and eat McDonald's or whatever it was. So we're always super tight on budget. My parents sought bankruptcy when I was young. They spent way too much money giving me privilege of extracurricular and whatnot and a good education. But that kind of gave me the drive to get into real estate. So it was a part-time real estate investor just after college, but at the same time trying to be a tech entrepreneur. So,
and this was in Toronto area?
Yeah.
Gotcha.
Yeah. The Toronto market is a weird one. It's very expensive. So right now it's like 1.2 million is the average single
median
detached
income,
home.
Median household price. Yeah.
Yeah.
Wow.
It's nuts.
Wow.
And so back when I started, you could get something for 300,000, but it was like on the outskirts, deep dilapidation. You're trying to go for the deep burr method.
Right.
So I attempted a few of those, really sucked at them, but I think I walked away with some money. According to Carmen, I did. And then my first venture capital startup came to play. I moved to California, and that's when she introduced me to the single family rental market in the US. And I was like, positive cap rates, $100,000, $150,000 homes. What world am I living in right now?
Right.
So that's when that sort of started. A good thing I deployed some capital there, deployed some more after I sold my first company.
Where?
So at that time was in St. Pete's.
St. Pete, right up the road. Okay.
Yeah.
Okay.
And so, at that point I'd never seen positive cap rates, so I was all in regardless.
Right.
And then.
So you bought your own stuff, and then you started thinking about this technological solution for people.
Yeah. Like fast forward, it was the pandemic that really drove it. After I sold my company, moved back to Canada, and the pandemic was like, okay, well, what am I going to do? I need to extend my runway here to do another startup. Let's go deploy some more capital in single family. And I'm like, why is this world not more advanced? Why is it still this long, arduous 6-month process? It needs to be lower risk. These are hardworking Americans trying to build wealth, and they're busy. So how do we kind of reduce that friction? And that's when the sort of investigation into what tools are there and how do we make this work.
Nice. So as this business was progressing, and as you I'm sure you didn't, your first deal was the hardest, or first house you got for somebody, or first few houses. Any epiphanies in this journey? Any aha moments like, okay, now I get it. We got to do it this way instead of that way. Any of those?
Yeah, we played with the idea of fractional real estate. Are you familiar where you kind of put in small increments?
Mm-hmm.
But then the value isn't there for real estate. If you're going to buy real estate, you should be able to leverage it. No bank or institution is going to acknowledge my increment of $5,000 in this investment and leverage it.
Right.
And you don't have control over, you got someone else who's got your liquidity button. They're pushing that. So we're like, let's move away. And the crowd was a bit younger. You got to hold their hand. And it's like, you're spending all this time for a couple $1,000s. And then you have sort of the middle-aged professional who's like, look, I'm probably late to the game here of real estate, so I want to deploy some capital. I want to get in. So that's when we knew it had to be whole ownership, and we have to kind of cater to what they're looking for and help them get to their timelines. Interesting.
So with what you know about real estate now, you've done it yourself, you're helping other people do it. What words of, what would you say to aspiring real estate investors? They know they need to do something with their lives. They need to, they're listening to this show. They want more than their W-2 job, their rat race existence. They need to move past that. What would you say to those people?
The FOMO is real. Don't wait 10 years, then you're going to be that same old schmo that's like, I should have bought way back then, because everyone who's done it still says that. Why didn't I buy more?
Right.
Why didn't I buy more? It's not going to go down. If it dips, it dips, but that's just a dip.
Right.
It's not going down and staying down.
Thank you.
So move. If it pencils, get it.
What else can you buy that someone else pays for?
Yeah.
Right?
Yeah.
Is there a book that you gift more often to people than others?
Yeah. There's a book by Ben Horowitz, which is called The Hard Things About Hard Things. And it's the journey about...
That's the book you just gave me, brother.
Yes.
Thank you, man.
Yes.
I appreciate that. Well, so you gift that one a lot. It must be damn good. I'm going to read it.
Like it's twofold. One, it's like, I learned from other people's horror stories, their war stories.
Just listen to my podcast. You'll hear lots of them from me.
And I love that question that you always give everyone. It's like, well, tell me about it, like the worst time of your life.
All right. Now that we went there, tell the worst real estate experience that happened to you.
Well, I've been fortunate that my worst real estate experience has been COVID, but on my Section 8 homes, so that wasn't so bad.
Okay.
We got the ERAP, we got all the fun stuff. So, but I wouldn't mind sharing a horror story about my last company, and like for me that was the kicker to get more real estate. Okay. Which was,
So what was the company?
It was called Kingmaker. Okay. And I know this is sort of really out of scope.
Kind of a cheeky name, but
it is. Kingmaker. We were like, we try to be behind the scenes, and what we were doing, we were helping YouTubers monetize their audience through commerce, because YouTube didn't allow that at the time.
Interesting.
And we had raised some capital. We were heads down. And the way startups world is, you get a bit of capital to get you to another milestone. And if you can kind of hit those milestones, then it's easier to go raise more capital to blow up the team.
And were you in California doing the Silicon or whatever?
Yeah, I was in LA at the time.
Okay, gotcha.
Because we're content creators. It made more sense. And 3 months before we run out of cash, our lead investor says, we're not going to re-up on you unless you take the company in a complete different direction. Oh. And then our secondary investor, so our lead investor is like the anchor investor. And then our secondary is like, well, we want you to go a complete different direction. At this point, my wife is like 6 months pregnant.
Oh, geez.
And I'm already a bi-coastal husband. She was in Toronto.
Oh, no
She's
kidding.
coming back and forth.
That's no fun.
And then I just think we had like weeks left of cash. And then we managed to pull off an acquisition. And that acquisition was in the Bay Area. It was nerve-wracking. We had to let go of everybody, managed to recoup some of the team and get them as part of the acquisition deal.
Wow.
And having to go back and forth. So we had to shut down the office, liquidate everything, physically move between offices after work in the Bay Area. And now I'm an employee working for a fast growth startup, working 14-hour days, new dad.
Wow.
It kind of sucked. But that's when it was like, the FOMO is real. Like, I should have focused more on my real estate, and I'd be less dependent upon having to swallow this horrific tasting pill and continue working at a company that I don't want to work at.
Yeah, it's a good story. And I think that probably resonated with a lot of people, a lot of my listeners. You got to take action, guys. That's the bottom line. If you don't, you'll be in the same place you are a year from now, which is great. If you love where you are right now, no problem. But if not, massive freaking action, right?
Yeah, and life changes. Something could happen that you realize, look, I want to slow it down. I want to take a break.
That's where I'm at right now, actually. I want to look at life through a lifestyle filter. I'm traveling like a maniac. But yeah. Well, listen, brother, I really appreciate you coming in and coming all the way from Toronto. And I told you it's on my bucket list, so I got to hook you up when I go up there and have you show me around, or at least tell me 100%. Where to go. But yeah, that's been on my bucket list for a long time. And you said don't go when it's cold. Yeah, it's all right.
Everyone's angry.
Yeah. Oh God, no. No. Well, listen, it was a pleasure to meet you, brother, and good luck with your. It's not a startup, but it's fairly new. Good luck with your company, and it's very interesting. And I think again, what you're charging is very reasonable. So,
thank you.
Good to meet you.
Thanks for having me.
You bet. So, one other quick thing: we encounter so many people that are frankly frustrated. They're looking in the mirror and they're frustrated that they haven't been able to escape the rat race. They haven't been able to build cash flow to the point where they're able to have financial and time freedom with their families. And maybe they see other people buying real estate and creating, incredible cash flow, and they think, well, it's just scary. Buying apartments is intimidating. And I get it. But see, that's why we created our Warrior Mentorship Program. They're our coaching students, and they've had extraordinary results. My students, I've been teaching about 5 years, and they own upwards of 140,000 units now that we know of, right? And we feel like it's just getting going. Now, we're looking to grow this group and really take it to the next level. And honestly believe that the greatest transfer of wealth could be upon us right now with this current economic environment. Everything's going on sale. So we're looking for people who want to follow a proven framework, really like a blueprint or a map, literally step by step. And then they're able to leverage our systems and our incredible network to raise money and equity, to find deals and close those deals and build partnerships, really nationwide. So if you're interested in finding out more about how you can become more in our incredible network and take advantage of the unbelievable opportunities that are upon us, you can apply to my Warrior Mentorship Program by texting the word CRUSH to 72345, or you can go to mentorwithrod.com. And what we'll do is we'll set up a call so you can check us out and we can check you out and see if it's a fit. Now, again, you can go to mentorwithrod.com or text the word CRUSH to 72345 to apply, and we will speak soon.